Okay guys, good afternoon. Pinching a punch, first day of the month. First day of September, so we've survived August, and actually not too much of a bad August. Normally August can be incredibly quiet. We did see light volumes, but we saw more action than you'd normally find in the quiet summer month, as normally many of the big traders are away. As I speak, Piers is sunning himself in Italy, so that sets the precedent. But let's have a look at what's been going on. I hope you can hear me, and if you can see my charts, can you just type Y in the room, please? Okay, great stuff. Let's have a look here. I'm going to increase my E-mini S&P chart first of all. We're looking at the 35-minute chart. Okay, and this is the rally we had on Friday, and then Monday's disappointment, as I was referring to Tuesday, Blue Monday. Yesterday was a pretty quiet day overall. Let's have a look if I go from really 11:30. Take it on the overnight session. And again, this key level coming into play yesterday, which is 10.37.25, and you can see from our strategy that is the second target for our short today. So 10.37.25 coming in as a key level once again. If you look actually on a slightly longer term chart, you can see these are the ellipses I've left in there, once, twice, three times, acting as a very, very strong support level. I mean, it's a key level. 10.37.25. Originally it was around 10.40, but it's just established itself slightly lower than that. Okay, so all eyes on that, and what we've noticed over the last couple of weeks, and you guys have seen this too, even on negative news, when the E-mini S&P has reached crucial support levels, there's been some very obvious and aggressive institutional buying at these levels, which has literally, and on the case on Friday for example, moved the market from its lows to its highs very, very quickly. I've been saying all last week, when we saw this strange reaction in stocks, even when commodities or other correlated assets were moving to suggest that stocks could move lower, you'd find the buyers step in very aggressively. And my most frequent comment was, guys, don't mess with the bulls here. If you can see this severe buying desire coming in, don't stand in the way of it. So what happened yesterday? Well, we had the minutes from Fed, a bit more detail about their monetary policy, and there was an initial disappointment. So let's have a look at the chart. That was around 7 o'clock. So this big red candle here forming that disappointment from the lack of commitment to further QE from the Fed. As we knew on Friday, really, we weren't expecting any clear surprises, but let's just have a quick review of what exactly was said there. The FOMC membership still saw economic expansion continuing, and most believed that inflation was likely to stabilise near recent low readings in coming quarters, then gradually rise. Okay, so that's absolutely fine. Nonetheless, however, members generally judged that the economic outlook had softened somewhat more than they had anticipated. Okay. FOMC members generally saw both employment and inflation as likely to fall short of levels consistent with the dual mandate for the longer term than had been expected. So definitely some bearish comments coming out there from the Fed. I think on the whole this was obviously priced in. I mean, they're not stupid. They've seen the macroeconomic data disappoint. But this is something I'm going to come on to later. Although the data's disappointing, it's not a disaster, and we'll see that certainly this morning. So what happened? Well, on the back of the Fed's meeting, we had this move lower at one red candle, and then you saw strong buying power coming in around the level that was resistance earlier on in the afternoon session, 43.50, form a sharp move higher again to go and make highs into the overnight session. Okay, this morning, this trend continues, and what's happened? What's it on the back of? Well, we've had the kind of data today that really puts all double dip theorists in doubt, casts a shadow over their view. If you look at the data worldwide, China PMI and business sentiment did not come into negative territory, as the negative inclined would have hoped. The double dippers would have liked to have seen disappointing data coming out of China. That is not what we got. In fact, it rose from 51.2 to 51.7 for August. So positive data coming out of China. Also interesting of note of the overnight data was that the export data was positive for China, and this is interesting on a worldwide scale. If exports are positive from China, then it gives a positive indication of global growth, global demand. Okay, so foreign demand is still available. The evidence for expansion is therefore still there. Okay, none of the data certainly coming out of China means that they're plunging into a downturn of dismal recession and dismay. It just suggests growth, although not impressive growth, it's still growth. Okay, this looks nothing like a double dip. And that kind of trend also confirmed by Australia. Their second quarter GDP better than expected, 1.2%. 1.2% again, a private sector recovery, and this gives an indication of global growth, as many of their exports, many of Australia's exports, as you guys obviously know, are commodities. And so this shows an improvement in the global growth area. Okay. So some interesting data coming out of Asia, and then this morning we had further data coming out of Europe, mainly manufacturing PMI and German retail sales. Now, German retail sales disappointed, but other than that, the PMI, the manufacturing outlook, was okay, either in line or slightly better than expected. UK manufacturing, however, disappointed, month-on-month 54.3 versus expected 57. Cable took the resulting dip that you would expect. So, what's going on? Well, let me read. You guys have shared a couple of articles here I'd like to just quote on. We've had a strong opening today after a dismal August in data as encouraging manufacturing from China and better than led export growth from Australia. That's right. You will see from our morning report, however, we are still looking for a short entry on the E-mini S&P, and this is quite brave, I believe, given that there could be a slight turnaround in sentiment out there. Our entry short looking at 1064.75, so you can see we found resistance just below this level. Andrea's been doing his analysis, and he reckons this data will disappoint. And I wouldn't be surprised if it does. Our first figure out in 45 minutes is ADP employment, obviously in the build-up to this Friday's large one, non-farm payrolls. Market consensus 15, but a range of -50 to -55, so nobody knows. We're expecting this data to disappoint. Employment has been a real issue for the US, and I'd like to share an article that I was reading this morning about the structural problems in the US. Apparently only 2/3 of the employment issues in the United States can be attributed to cyclical variances. Okay, 1/3 is actually now down to a structural change in the way that the US operates. That structural change being, number one, more women are in employment, which means the transportable value of labour. The US was always fantastic at moving labour in between states, wherever jobs was, in between vast areas of the country. But if you've got now two members of the family who are in stable employment or who are in employment, it's harder to shift to where labour opportunities are greater. Number two, a lot of the US citizens are holding negative equity value in their house. They do not want to sell whilst they owe more than the value of the house is worth. This is preventing them from moving perhaps as fast as they should have moved. Number three, many of the unemployed in the US economy are from the manufacturing or from the construction sector. It's very difficult for these guys to now retrain into other growth areas of the economy. Okay, there's been this delay. The most worrying part of the US employment figure, I believe, is that over half of the total figure are long-term unemployed. Okay, the longer someone's unemployed, the more difficult it is for them to get back into work, as they